Chapter 19, Order Types. When you buy a stock, you send your broker an order. The type of order you submit determines what price you buy or sell at alongside how quickly your trade executes. Additionally, you can use some order types as trading utilities to strengthen your risk management and technical analysis skills. Market order. What you select: the ticker, buy, sell, short, cover, and number of shares. When the order executes: immediately at the market price. Physical electronic signal travel times may slow your order down by a few microseconds. How the order executes: you buy from the cheapest seller on the ask, or you sell to the cheapest buyer on the bid. In practice, market orders work like less predictable limit orders that execute more reliably in fast price changes, although you may buy or sell into a wider bid-ask spread. Limit order. Well, you select the ticker, buy, sell, short, cover, number of shares, and the price. When the order executes, you send to market immediately, filled as soon as someone buys or sells at your designated price or better. How the order executes: once you submit your order with a specific price, it appears in the market's bid or ask, market depth, level 2, etc. As discussed earlier, you're filled once somebody buys or sells to you open order that can be above or below the current market price. With most brokerages, your order will be automatically filled at cheaper prices than your limit buy order, or sold at prices higher than your limit sell order, if better prices are available in the market's order book. Market if touched order, form of a stop order. Well, you select the ticker, buy, sell, short, cover, number of shares, and the trigger price. When the order executes: when the last traded price hits your designated price level. How the order executes: in a buy order, you pick a level above the current price. When the stock hits this level, you market buy the specified number of shares. Similarly, you pick a level below the current price in a sell order. When the stock hits that level, you market sell the specified number of shares. Stop order. What you select: ticker, buy, sell, short, cover, number of shares, trigger price. When the order executes: when the last trading price hits your specified price level. How the order executes: these orders close out your current positions when a stock moves to a predetermined price. Once the last traded price of a stock hits the price level you specify, you buy or sell the given number of shares in an automatic market order to close a losing position and limit your losses. Stop limit order. What you select: ticker, buy, sell, short, cover, number of shares, trigger price, and the order price. When the order executes: when the last trading price hits your specified price level. How your order executes: your broker issues a limit order into the market only once the last sale price reaches your stop price. You can set your limit buy or sell price to be higher or lower than your trigger price, which makes the order active when the market hits it. Just in case the price moves quickly past your designated order price and you still want to get out of a losing trade, your order will be filled at the best price your broker can find in the market relative to your execution price. You might see fast-paced movements, especially in 9 to noon stocks, if you set your stop loss at a support or resistance level, as we will explore in Chapter 24. Therefore, automatic stop losses with price flexibility can ensure that you get out of a failing trade before potential losses compound. Trailing stop loss order. What you select: the ticker, buy, sell, short, cover, the number of shares, the trailing amount. When the order executes: when the last trading price hits your specified trailing price level. How the order executes: you set an initial stop loss alongside a trailing amount. In a long trade, the stop loss level increases according to the trailing amount. For example, you buy at $10 and set a stop at $9 with a $1 trailing stop. If the price increases to $13, then your stop loss now increases to $12. However, the stop loss in a long trade will never decrease after a new high is hit. Reverse this information for a short trade. Conditional orders. What you select: the ticker, the buy, sell, short, cover, number of shares, and the conditions. The number of conditions and the extent of such conditions depend on your broker. When the order executes: once all your conditions are met. This order is a great way to ensure your swing trades execute exactly where you want, even though you might not be able to actively monitor your positions. How the order executes: first, decide whether you want to buy or sell at market or at a specific price. Then, establish your conditions. Should your order only execute if the price falls to X support level? Perhaps you want to automatically sell half of your position at Y resistance level. We will explore supports and resistances in Chapter 24. Maybe you want prices to reach a certain level an hour after opening volatility fades. Perhaps you have a particularly large position and want to take profits off the table after prices increase 10%. Look at the conditional options your broker gives you and see if they fit with your trading style, allowing you to establish a setup and let your broker fill it when prices are just right. Stop losses set a maximum amount you can lose in a trade, acting as a terrific way to mitigate risk. You set a trigger price for either a market stop loss or a stop limit order. Once a stock trades at this price level, your order automatically enters the market. This speed is especially helpful when you want to quickly enter or exit a position. You can place your stop loss trigger price below the current price to limit your losses in case a trade goes south. Similarly, you can place stop buy orders above the current market price to limit your losses in a short position. You should set your stop price based either on your risk tolerance, how much you're willing to lose on any given position in the short term, or technical analysis. With trades based on technical analysis, try to set your stop loss at a price that proves your trading setup or indicators invalid. We'll talk more about technical analysis in part 2. Your limit sell stop loss order should effectively close trades that are primed to lose you more cash, but they should also allow enough wiggle room for your position to continue longer term movement despite brief pullbacks or run-ups. Market stop loss orders ensure that you liquidate a position in case the price action quickly moves past your stop level. For example, critical supports and resistances in 9 to noon trading. For long-term investing in more stable stocks, stop limit orders generally work well enough for protecting profits or limiting losses and guarantee your closing price. In relatively stable stocks, try to wait a few seconds in 9 to noon trades or a few days in long-term investments to see if a stock will correct itself away from an extreme once you have enough trading experience and willpower to cut a bad position without a hard stop loss. We will talk more about price levels, supports, resistances, momentum indicators, and price bands that will help you with this technical analysis in part 2. In most scenarios, limit orders are the best way to enter and exit a position. Limit orders are the most consistent and reliable order type because you designate exactly where your trade executes. With this guarantee, you can always know how much you will pay for a position or make it from its sale, especially in the liquid markets with large bid-ask spreads. Limit orders at the top of the bid or bottom of the ask can save you significant percentage points in your trades. Shave percentage points off the cost basis of your trades and increase your long-term profitability by consistently buying with limit orders near the bid for a small discount or selling with limit orders near the ask for a slight premium over market prices. With that said, market orders can be extremely useful in 9 to noon trading. When prices move quickly in fast-paced trades, you may not have enough time to enter a specific price before a stock shoots past it. In these scenarios, the increased execution speed provided by market orders can help you enter or exit extremely volatile positions. For instance, let's say you find a very promising stock. This was a $4 stock yesterday, but the underlying company released stellar news last night and is about to open at $5.20. At $9.20, you look at key historical support and resistance levels to determine that the stock is prone for a high flyer for the day because it just broke its toughest historical support. We'll talk more about supports and resistances in chapter 24. The opening bell rings, the stock starts to skyrocket. Prices just keep ticking higher and higher within the first 10 seconds of trading. Since prices do not slow down long enough for you to calculate the number of shares you should buy and type in a price for those shares, a market order with an approximate number of shares can ensure you get skin in the stock before it soars too high. Still, use these orders sparingly as they can be unpredictable and set your order back up to a few percentage points with some particularly poor fills. For long-term investing, market if touched orders can be a great way to automatically purchase a stock if it significantly and quickly drops, whereas market if touched sell orders to lock in gains if a stock significantly and quickly rises. These orders are great to set a price you think the market would never fill out unless a panic quickly and temporarily moves the stock in one direction. For example, there's an extremely large, unnaturally rapid single-day sell-off in the Invesco QQQ Trust on August 24, 2015, as shown below. With a market if touched order, you could instantly lock in a position at the market irrationally drop without ever needing to consistently monitor monitor the price level. As you might notice, Day's extremely large red volume candle further emphasized this buying opportunity. And then we see super crazy, super big red volume candle on the August 24th in that chart, and you can see there was a huge sell-off on that one day where the stock dropped to a previous support level, and that big candle was just a huge single-day drop where people got filled really, really quickly, and then the price moved away from it really, really quickly. And in the long term, it just kept going up after that since it was a long-term compounding index fund. You might not be watching QQQ on this one day when the fund dropped 20%, so your automated order ensures you take part in the drop opportunity. Still, remember to check up on your long-term open orders periodically so you do not forget about an order in which market sentiment on the underlying assets slowly changed. For example, it no longer makes sense to buy or sell at the market if touched order price.